Hi, my name is Evin Raj. I'll be explaining about the separate entity concept and also the going concern concept. Okay, what is separate entity concept? Separate entity concept says that a business and its owner are two different things, whereby it is mean that the money the business makes and spends should be kept apart from the owner's personal money, where every financial transaction must be belong to their business or the owner, right? uh, for example, we use a cafe for example. Like John owns a cafe, a small cafe, where he earns money from the cafe, but when he buy groceries for his house, that's his personal spending. John must not mix with these two. If he uses the cafe's money to buy his groceries, he need to record it as taking money out of his business, like owner's drawing lah. Okay, not as a business expenses. Why separate entity concept is important? It's because for clear records, where it helps keeps things organized, and also avoid confusion with taxes, like the owner's income and the business income stays separate, making tax feeling easier. Plus it protects personal money, like if the business owns money, the owner's personal savings are safe, especially for companies with limited liability. Okay, for the going concern concept assume that a business will keep running for a long time and won't be shut down anytime soon, whereby it means that the business can pay its bill, keep selling products or services, and will sustain, and also will stay open for a seeable future. All right. For real life example, the same cafe example for previous one. Imagine John runs a cafe. If a cafe is doing well, selling goods or foods daily, and paying its supplier on time, people assume that it will stay open for long term, whereby this is a good concern idea at work, where the cafe is expected to keep running and saving customers for years. Okay, why this concept is important is for planning for the future, where business make plans and investment, and assuming they will keep running. Moreover, building trust, where suppliers, banks, and employee feel secure working with the business, and also avoid panic selling, where if a business assume it's closing soon, it will need to sell its asset quickly, which could result in losses. This going concern concept help to avoid this. Okay, that's it from me. Thank you.
Hi, I'm Yarish Kesavan, and I'll be explaining about the two concepts of accounting, which is money measurement and objectivity concept. So as for the first concept, money measurement, this concept explains that only transactions that can be measured in money will be recorded in the financial accounting. So for the example of it, I would say that the value in financial statement can be measured in money, like for an example 500,000 ringgit Malaysia. Therefore, a company buying a 500,000 building is recorded in the financial statement itself. So that's for money measurement. And the second concept I'll be explaining is objectivity concept. So the meaning of it is that it ensures financial information are derived from verifiable evidence, not on a personal opinion. So for the example, I would say that the supplier's invoice serves as objective evidence of transaction, which a company records when it is a purchase when it purchase any kind of machinery. So that's the examples and the concept of this both money measurement and objectivity concept. Thank you.
Hi guys, I'm Rinesh. I'm going to explain about the accurate concept in accounting. The accurate concept refers to the principles that transactions and events shall be recognized in the financial statement when they occur rather than when cash is received or paid. The concept is fundamental and accurately dissipating the financial position and the performance of an entity or over a specific period. For an example, the key points is revenue recognition. Revenue should be recorded when it's earned, not necessarily while cash is received. For example, if a company sells goods to a customer on credit, the revenue recognized at the point of sale, not when customer pay later. The next we can use expense recognition as an example. Expenses should be recognized in the period when they are incurred, not when they are paid. For instance, if a company receives an invoice for service rendered, the expenses is recognized immediately, even if the payment is made in the following accounting period. Next is materiality concept in accounting. The materiality concept in accounting refers to the principle that financial statements shall only include information that is significant or material to the users of those statements. Material information is the key detail that could influence the economic decision of those reading the financial reports, such as investor, creditors, or management. For example, the key points we can use is relevance to decision making. Materiality is a judgment call. Information is considered material if its omission or misstatement could affect the decision made by users of the financial statement. For example, 1,000 ringgit error might be a material to a small business but insignificant to a large corporation. So that's all from me. Thank you.
Hi everyone. Next, I'm going to explain the constituency concept. The constituency principle states that once a company adopts a certain accounting policy or method, it must apply consistently in future as well. This means that similar event transaction over time will have the same accounting treatment. The consistency principle requires that companies have a consistent set of policies and standards that are used while preparing the financial statement. If the company chooses to change its accounting policy, it will need to disclose this change in its financial statement, including the financial impact of the change. Data of change and the returnable behind this stage. Using this consistency principle, a company will have a similar structure for its financial statement each period. This will make it easier for investors, creditors, managers, and other shareholders to compare the financial and operational performance of a business different years. For example, Apple Computer has been using the first in, first out FIFO method for valuing its inventory in the recent years. Apple Computers has become quite large and profitable. A consultant advises Apple to change their inventory valuation method to last its first out LIFO to minimize to taxable income. As per consistency principle, the company can only do this if it has justifiable reason. However, or not reducing the tax will be justifying is inevitable. Thank you, everyone.
Hi, my name is Tanindra Sivaraja. So now I'm going to talk about comparability. So comparing financial performance over time for a single company or between different companies is influenced by accounting standards like IFRS and USGAP. So for single company comparison, consistency and trends, there's two different factors. So in consistency, using the same standards over time ensures reliable comparisons, and for trends, financial ratios can reveal trends, but changes in accounting policies may affect comparability. So for intercompany comparison, standard differences and cross-border analysis, different accounting standards can lead to inconsistent financial results, requiring adjustment for accurate comparisons. For cross-border analysis, companies under different standards may report variably, affecting comparability, especially in international contexts. So, analyze often makes adjustment for consistency for comparability. So overall, while accounting standards provides frameworks for reporting, they significantly impact both based on cross-company comparisons. So that's all for comparisons. Thank you.